Losing money in the stock market is expensive, and that's because if you lose 20%, you need 25% to break even. You lose 25%, you need almost 33% just to break even. I don't know about you, but I don't enjoy losing money in the stock market at all. And no, you can't prevent every single mistake and loss out there, but there are some things that you can help stop some of the most common mistakes, and that is what we are going to do today. And I can argue that about 90% of investing mistakes can be fixed with these three things: allocation, correlation, and preparation. Those are the three things. So exactly how do they work, and why do I think they can help 90% of investors reduce their mistakes? Let's first start with allocation. This is the mix between stocks and bonds. Now, what I have seen with my own eyes, all right, I'm a financial advisor that can help you to create clarity, confidence, and momentum in this here economy. We can talk one-on-one. I can take a look at your portfolio at buildingbread.com/callkev. But what I have seen when I look at a lot of people's portfolios, which I've been doing for forever at this point, is everybody should have an allocation that's, let's say, for example, 80% stocks, 20% bonds, right? What happens is that determines, there are some studies that say it's about 90% of your returns is based on that. However, if you are somebody in your 60s, you don't want to invest like someone who's in their 20s. And the reason why is because the person in their 60s might be retiring in the next 5 years. If the market were to drop for you, person in your 60s, you might not have time for the market to recover. There may not be a year where the market is going to have 25% to recover, whereas a person in their 20s, they got a long time for the stock market to recover. That is the difference. You might want to take much less risk. You got to take a look at your portfolio and say, where am I supposed to be as an investor, and how close am I to that specific mix to you? One of the easy back of the envelope rules of thumb, it's a rule of thumb, it's not the most scientific way, just throw it out there, but it's a rule of 110. So 110 minus your age, I'm just going to use 30 as an easy round number. That's going to give me 80. 80% of my money should be in stocks, 20% should be in bonds. Now that is a general rule of thumb number. I just want to keep throwing that out there. But if I am somebody who says, okay, well, I did this thing and it said 80-20 and I am at 50-50, 50% stocks and 50% bonds, hey, it might be something wrong here. All right, that's something that I might want to go and check out. Let's say you did the rule of 110 and it says you should be 60-40. You look at your 401k and you find that you're 100% stocks. That gap might signal something might be off. So the allocation is extremely important. What you would need to do is go into your 401k and perhaps look at changing those allocations, or speak to an advisor beforehand or have them help you to do that. A lot of times if you work at a job that has a 401k managed by like a Vanguard, an Empower, Fidelity, you can talk to them and they can help you to do that. I can also help you do that for you. But if you're already there and they working with it for free, why not, right? Why not say, hey, look, I ain't talked to you in a while. Help me to do this because I'm not sure if I'm allocated properly. It might be worth a quick 10 to 15 minute phone call. They might try to sell you on something else, but hey, I'm just letting you know your resources, all right? Now, the next part is really two things. So here's one of those bonus things. It is correlation and concentration, all right? Correlation and concentration. Correlation is your portfolio moving exactly in line with the stock market. For example, we generally say that an S&P 500 index fund is perfect, I'm putting that in air quotes, perfectly correlated with the stock market. When the stock market goes up by 1%, that S&P 500 index fund basically goes up by 1%. That is correlation. Now, you don't always want perfect correlation, because depending on where you are, when the stock market goes down, do you want your money to go down? No, not all the time, or especially not by the exact same percentage. So in some cases, you want to build a portfolio that is not perfectly correlated. That is why I might want an 80-20 mix, because those bonds usually aren't correlated with the stock market in the same way. And I'm just giving you an example here. If the stock market goes down by 1%, maybe I'm only losing, I don't know, 0.8% or 0.5% or something like that. Why does that make sense? Well, over an entire year, if the stock market is down 10 and I'm only down 6, that makes a difference, because remember what I said at the top of the video, you lose 20%, you need 25 to break even. You lose 25, you need 33 to break even. If I'm not losing as much, it doesn't cost me as much just to break even when and if the stock market falls. That part is extremely important, and the only way you're going to know that is by looking at your portfolio and seeing what you own and having the right allocation mix, but also concentration. Concentration is important. This is something that a lot of us don't always look at. And I've done a video on how to kind of see this in some cases, but this part is the thing that's overlooked. We like index funds here, okay? I ain't got no beef with index funds. I also enjoy talking about stocks. However, you want to see where your money is concentrated, where your portfolio is concentrated. For example, I like investing in domestic stocks, domestic meaning the US, though we are an international channel here. But in either case, it's just what I'm familiar with, what I was trained in, licensed in, all that type of stuff. But that's not the only place that's making money. South Korea was a shining example last year. There are a lot of places in the Eurozone, so Germany, the UK, other spots, that did quite well. Well, if you are looking at your portfolio, there are tools out there, again, the one in the video is one I talked about, that show like, hey, you are overly concentrated in just the US and nowhere else. And in a year like we had last year, and perhaps a year like we are seeing so far in 2026, you might want to look at that. Now, how do you fix this? One, we talked about this before. I did another video here on international funds. You might want to go back and check that one out, and you can just get an all world fund where you just got the whole thing. So that's one easy way to do it. Or you can drill down and say, look, here's where my portfolio is. I know I've got US funds. I know I perhaps have European funds. What other spots am I missing? Perhaps investing in Africa is a region you might want to invest in. Perhaps investing in Asia is a spot you might want to invest in. Look and see what you have. Look and see where your gaps may be, and see if those gaps are worth investing in. That's the other part. Now, every region is worth investing in. Go and see what's missing. Go and see what you might need, and see what is out there. See what's out there, because again, when you look and see and say, hey, South Korea made over 60% and you only made 15-ish in the US, it's a lot beyond the shores. All right, so go and see where your portfolio is concentrated. We know here, especially for the S&P 500, all of our focus and market returns are all on AI. Cool if it works, but I'd rather be just a little bit more diversified so I can make money in other ways in case that one thing doesn't work. And now we go to the preparation. How are you testing your ideas? How are you testing these ideas? Because what I have often seen, and I'll get these, text messages or emails say, hey, look, I saw or heard this thing, I'm going to do this, or I want to do this. Now, thankfully, I guess a part of the research is sending me that idea, which, I mean, sure. I guess that does count. Sending it to somebody who's that's their day job to do, yes, that counts. You're outsourcing it to me. I'm a nerd, is what I do. Fine. But you have to ask yourself, what are you doing to pressure test that idea? For example, I get a ton of people who just believe that Target and Nike, both Target and Nike, are just supposed to be these great stocks, and that they are bound to come back just because they love the shoes, or they just think something magical is going to happen with Target because they love the store. Everybody has boycotted Target at some point in time. Some group has been boycotting Target since like 2021. Yes, they switched CEOs, but the stock has been down ever since then. I don't see it coming back in the near-term future. Now, could I be wrong? Yes, I absolutely could be wrong. However, what can you do to test the theory that it is going to be right enough to put your money into? I've got 5 years saying that this ain't gonna work. And until I get at least 1 year saying that Target, where I can go back and look at the chart and say, hey, look, this thing changed, Target is making money, then we good. But right now that hasn't happened. Same thing with Nike. We've done several videos. I'm linking to a lot of videos here. We've done several videos saying, hey, look, I don't think Nike's working. I'm getting out of Nike. And they have consistently failed. It don't make sense to do that. And right now, the pressure test is, I'm looking at the results. It ain't working. They haven't changed their ways. Let's not do that. Right? Let's continue to not invest until they do something and we can test it. Right? My test right now is, if I invested X amount in this stock, for 1 year, for 6 months, and in this case, 5 years, I would have lost money. If I tell you, as your financial advisor, you put $10,000 in something, you would have lost 80%. What would I look like doing that? That's a test, right? That's not something that I can sell you on. That's not something I can get you behind on and say, yeah, let's believe me that this stock is going to turn around because you like the logo. That's just not, like, really think about that. And just because it's a good store and you don't see them go out of business that often, that's not good enough. You got to sit there and really pressure test that idea outside of what may be your own bias. And that's why I have a process to how I invest, and it's one I've been using for probably over a decade at this point in time. But those are the things you absolutely have to have: allocation, concentration, and preparation. Or you can add the extra C and correlation, but that would be a CCP. And I just think that 3 just goes better. It clicks a whole lot better. But if you want to learn more about investing or some of the tools that I've used in the past, those videos are out there. We are at more than 1,700 videos on this here channel. You should also go ahead and hit that subscribe button. But since you're already here, you should go out and check these videos next.